Professor Morgan-Nance here. Welcome back to Financial Accounting. In Chapter 9, our videos will discuss current liabilities in detail, including notes payable, and taking a look at the basics of payroll accounting. This first video will review sales tax and unearned revenue liabilities. We covered the basics of defining current and long-term liabilities in an earlier chapter when we classified our balance sheet. By the time you've completed this chapter, you will be better informed about the different ways in which companies bridge their short-term cash flow needs with current liabilities. A liability is an amount we owe today that was caused by an event that already happened in the past and will require us to pay cash or sacrifice something in the future to extinguish the obligation. Liabilities play an important role in financing most business activities. Remember, assets are financed by a combination of liabilities and equity in the form of stockholders' contributions or the company's operations. Liabilities are created when a company buys goods and services on credit, uses employee labor and pays sometime later, obtains short-term loans to cover gaps in cash flows, and issues long-term debt to obtain money for expanding into new regions and markets. Remember that current liabilities are also called short-term liabilities and are required to be paid within 1 year or the normal operating cycle of the company, whichever is longer. They are usually paid off with current assets but can be satisfied by creating another current liabilities. Now, long-term liabilities are not expected to be paid or extinguished within 1 year. In this chapter, we will concentrate on current liabilities. The relationship between total liabilities and current liabilities depends on the nature of the company's operations. Some liabilities require payment during the next 12 months and beyond. These liabilities are separated into their current and long-term portions on the balance sheet. Common examples include car loans and mortgages and other loans and some contracts. When a current liability crosses several accounting periods, a portion will be classified as current and a portion as a long-term liability. A common multi-year liability includes long-term notes payable that have a portion maturing each year. The portion of the note payable that will be paid in the next year, the next 12 months, is reported in the current liability section of the balance sheet, and the remaining amount will be classified as long-term debt on the balance sheet under long-term obligations. We will look at notes payable more closely in a later section of this chapter. In general, the accounting for liabilities requires 2 types of journal entries. The first entry is made to record the liability when we receive goods or services without paying for them or receive money before doing anything to earn it. The second entry is made to reduce the liability when we pay it in cash or do something to earn the money that we previously received upfront. Here are some examples of liabilities that have characteristics that we know who to pay, we know when to pay, and we know exactly how much to pay. That is why they are called known liabilities. If we don't know all 3, we do not have a known liability. Examples of liabilities that are known that we've seen previously include accounts and wages payable and unearned revenue. As we go through the chapter, remember that 2 journal entries are needed to record and then pay liabilities. Let's look at sales tax payable next. Companies are required by California state law to collect sales taxes on certain taxable merchandise. We won't go into the details of which merchandise is taxable, as it does get quite involved. Sales taxes are stated as a percentage of the selling price and are due even if the seller says they're having a sale where you, the customer, don't have to pay the sales taxes. Ever seen one of those? What is important to us as we focus on financial accounting is that we must collect sales tax and that cash we collect from the customer is not ours to keep. It will simply sit as a liability on our balance sheet, a credit to sales tax payable, until we actually pay the cash over to the State Board of Equalization. The date a company is required to hand over the cash varies also, depending on the size of the company and past sales records. Believe me, if you set up a company and you don't collect and remit sales tax in the proper amount on the proper date, the state will eventually track you down. In short, then, when a sale is made, the seller collects sales taxes from customers, and a sales tax liability is recorded. When taxes are paid to the government, the liability is relieved or reduced. For example, assume on May 15, 2015, Home Depot sold building materials to a customer for $7,500. The amount of the sale is subject to 6% sales tax, and Home Depot is responsible for collecting and paying the tax to the state government. You might want to jot this down on your scratch paper to refer back to as we proceed through the example, and pause if you need to. We begin with a debit to the cash account for $7,950, the amount of the sale and the tax collected. We credit the sales account for $7,500 and credit the current liability account, sales taxes payable, for $450. The sales tax collected and owed is 6% of the total sale of $7,500. Now, Home Depot is required to pay their sales tax to the State Board of Equalization on the 15th of the following month, so on June 15th, they send $450 to the government. The required journal entry debits the sales taxes payable account for $450 and cash is credited. Remember, the entry must always balance. Note that the sales tax payable account balance then becomes zero. It's simply a conduit, a way for the government to collect tax money. That cash was truly never ours. You will see that payroll taxes work in a very similar manner when we have a look at the payroll tax liability in a bit. We previously studied unearned revenues in Chapter 3 on adjusting journal entries. Unearned revenues are amounts received in advance from customers for future products or services. Advance ticket sales for sporting events or music concerts are examples, as are advance sales for airline tickets and magazine subscriptions. Unearned revenues are usually current liabilities. They are a liability because the customer has prepaid and we owe something to them. In our example, assume Taylor Swift sells concert tickets in advance of performing 8 concerts. She receives $5 million in advance on June 30th. She now owes a concert to her fans and must either perform the concerts or send the money back. The advance payment is recorded as a liability called unearned ticket revenue. When a concert is played on October 31st, Taylor Swift has the right to record ticket revenue for 1/8 of the amount received in advance, or $625,000. Her accountant debits unearned ticket revenue and credits or increases ticket revenue for $625,000. That concludes our video. When you're ready, move on to our next video in our current liability series.